Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter, powered by BuyAlerts Pilot AI. We'll take a look in a second just how much of a assistance and a big help this can be, and adding it to your trading toolbox can certainly bring in a multitude of more trade ideas. So let's jump in and take a look. First and foremost, today is vol capture trades. Multitude of trades similar to Sable Offshore last week on Oracle post earnings, where Oracle has some unusual option volume, unusual implied volatility, and some plethora of trades to take advantage in. So let's jump in and take a look. First of all, here's the chart on Oracle. As you can see, here's the earnings, which we'll see in a second. Actually, the actual earnings missed by about a penny on the bottom line, and a fair amount on the top line, so fell short on both earnings and revenues, yet the stock ripped higher on somewhat insane guidance as far as growth rates. We'll see if those come to fruition. You see that the stock headed up to 345, then closed still higher, but well off the highs, has kind of found some semblance of support around that 300 area, sets up for a multitude of trades to take advantage of it. So here's that implied volatility on Oracle. Here were the earnings, as we talked about, right? The usual vol crush post earnings, but then since then, implied volatility, and this is 30-day, has shot up to the earnings level. So the earnings crush has all been but wiped out on the implied volatility front. You can see Friday IV even headed higher across the whole term structure volatility. Taking a look at it on a shorter term basis, this is the 30-day, right? Basically slightly out of the money calls, right? You can see here's the post earnings vol crush, which is normal, and then the rip back higher, so the crush and rush. So a great time to, in essence, sell that rush, take advantage of expensive options. IV percentile now at the 74% level, which means option prices have only been more expensive than this 26% of the time over the past year. And that's with the VIX basically trading near the yearly lows. We can also take a look at, here is that kind of vol crush and vol rush. So here it was IV, right? Pre-earnings, here's that earnings crush, and then the quick pop back up. So we're back basically at the same level we were before. And then longer term IV never really saw the dip. It is trading basically at the Liberation Day highs, right? When stocks were at Liberation Day lows and the VIX was at the high. We now see the VIX generally right off the lows, right? But we're seeing Oracle implied volatility near the highest level of the past year, especially longer term. So it sets up for certainly some vol capture trades. As we talked about the earnings, here's the valuations. I pulled off a price to sales chart over the past 20 years. You can see this incredible ramp up in the multiple here now at by far the highest not PE, but PS multiple over the past 20 years at over 15 times price to sales. PE following suit as well, over 70 times on a PE basis. So both price to earnings and price to sales at very much extremes here, right? And here's the actual earnings from last quarter, which we just showed on the chart when they came out. They missed by a penny on earnings, right? Revenues missed by a decent amount, right? But certainly a miss on both. But you saw that the guidance, if you will, the cloud revenue was where the excitement was, which is why you saw that stock absolutely gap higher here, right? Here is the earnings, but the stock ripped higher. Why? Because of the alleged growth that's coming down the road, which it's hard to fathom to me, right? The growth going from basically 10 billion last year to 144 billion, and this is just on the cloud infrastructure side, right? Over the next 4 years, so a absolute huge uptick, and they compete with some of the big names. So how they can do that isn't a guarantee, right? And especially when one of the analysts asked, right, really amazing to see, right, And this RPO is basically supposedly contracts on the road, but we know how those work, right? But he asked Katz, who was basically running the conference call, more clarity. How much is it going to cost to build out the infrastructure to, in essence, create and support this growth? So it should be interesting times indeed. I think the stock absolutely got a little ahead of itself here, and I think some of the AI euphoria is getting a little extreme here because there will be absolutely cost with it, and we'll see how the monetization of it by the companies is at the end of the road. As far as the use of it for what I do here, right? It absolutely is a huge benefit, and that remaining performance obligation, in essence, is supposedly contracts in the future for companies to, in essence, use Oracle, right? But we'll see how it all pans out. Regardless, stock is priced absolutely for a hypersonic growth. We'll see if it comes to fruition. And we're doing trades that are fairly short-term in nature, so 3-4 years out doesn't matter when you're looking 3 weeks to 3 months out. So let's jump in and take a look. First of all, here's a comparative I did from the last time the stock was about right here post earnings, right, until Friday's close, right? So the stock, and this is post earnings after it kind of came back down, right, after we had this pop and then the drop. So took a look there at the stock at 307.86 on September the 12th. So basically the previous Friday, right? You see the stock there, the 350 call, the out of the money call, right? Trading at $5.80. Implied volatility just under 50. Out of the money by 42 points. So this is a pretty decent out of the money call, right? If you want to look at it from a percentage basis, right? You can see that that call is simply out of the money. And let's do the quick math here. By about 13.5%, 35 days to expiration, a delta of 23. So the net delta on the trade, right, buying the stock and selling the call, right, would be simply 100 minus 23, or you'd be basically 77 deltas net long. So reduce your exposure, leave yourself upside to 350. Fast forward to this Friday's close, right, a week later. You see the stock at 308.66. So the stock went up 80 cents, right? The 355 call further out of the money, right, by 5 points, right? Stock up 80 cents. This call is 5 points further out of the money. You'd expect it to be cheaper, right? Simply because it's that much further out of the money. But lo and behold, it's 60 cents more expensive. Why? Because IV jumped over 5 vol points, now around 55. It was under 50 and approaching 55. Now, out of the money amount, right, by 46 points, or it increased 4.2 points further out of the money. So you have further upside out of the money percentage, right? Let's take a look at that. Simply take the out of the money amount by the current stock price. So 15% out of the money versus 13.5. So you have more upside, and the actual buy right, has actually gotten cheaper in price, right? That buy right before trading at a much cheaper price now, simply because that 355 call went up in price, right, by 60 cents, simply because the stock ripped higher. The stock went up 80 cents, so you get 5 points more further upside protection, right, without really having any additional cost basis on the trade. So that call increased 60 cents, even though it's 5 points further out of the money on that trade. So that is a nice comparative to show how much that implied volatility affected the price of options. Sets up ideally for a couple buy right trades. So on the kind of at the money one, this is the 310 call, right, that expires in basically about a month. So I look back to a week ago, Friday, September 12th, right, stock at 307.86. That 310 call, basically just out of the money at 18 bucks, a little bit more. So the buy right, buying the stock, selling the call, would have cost you about 290, touch less than that. So you reduce the risk, the cost on the trade, give up some of your upside, and hopefully increase your return as well. IV at the time on that call, as we can see, just under 50. Fast forward to Friday, right? Stock, as we said, 308.66. So it did go up 80 cents. That 310 call, and again, this is the same time frame, right? We're looking at a 34-day versus 35-day to expiration, basically the same exact days to expiration. But that call went up $1.45. So the out of the money call, right, roughly a 50 delta call, right, it's a 53 delta option, right, it's slightly out of the money, went up almost double the price of the stock, which means buying the call, buying the stock, selling the call got cheaper, even with the stock getting more expensive by 65 cents, simply because the stock went up, but the call we're selling to hedge that trade, right, reduce the initial cost, went up even more. So this sets up ideally for a covered call trade for those who want to lean bullishly with that big call buying out there, which has scooted up the implied volatility, in this case, by over 3 full vol points. And a stock like ORCL, that's certainly a lot. For those who want to lean even a little more bullishly, you can look at the 330 call, same sort of idea here. We went back a week ago Friday, stock 307.86. That 330 call trading about 10 and a half bucks. So buying the call, selling the, this should be the 330, right? Buy right came out to be 297.33, or just under 300 bucks, right? Because that IV was right around 48 bucks. Fast forward to Friday, stock did go up 80 cents to 308.66, but the 330, the out of the money call, right, which this call only has a delta of somewhere around under 40, 38 delta, so not nearly as high a delta. That call went up basically again double the price of the stock. So the buy right got cheaper with the stock getting more expensive. Why? Because the 330 call went up more than the stock went up. Rarely you ever see call prices go up more than the stock, but the reason it did is simply because IV went up 4 full vol points. So if you want to do the buy rights, you certainly have some bona fide edge on those trades, right? And out of the money put spreads, another way to get bullish. So here we can take a look very simply. September 12th, right, a week ago Friday. That November, let's go out to November, take a look at that, right? Because the full spectrum of implied volatility increased as we took a look here, right? IV has shot up across the board, so that full term structure vol has lifted here. We'll take a look at some Jan trades in a second, but you can see that the put spread selling the 250 put, buying the 240 put, which gives you about 60 points of downside cushion, right, was trading right around 93 cents or so. Fast forward to Friday, and because of that huge lift in implied volatility, right, that put spread now is trading just under $1.50. So the put spread has gone up 50%. Why? Because the put has actually gone up in price. Here you can see the put with the stock at 307.86, and this is a 70-day to expiration put. We kept the expiration the same, right? Was trading just over $4 at a 46.5 IV. That huge jump in implied volatility pushed it more towards $5, right? Even with the stock going up and a week coming off, so you have time decay, right? And the stock price going up, both should be a negative for put prices. In this case, absolutely, because of that jump in implied volatility now approaching 52. The put spread, the bullish put spread, got more expensive. So those who like more of a defined risk kind of low cost trade, selling that no 250, 240 put spread certainly makes a lot of sense. Or basically any put spread out there that fits your kind of, time to expiration and risk return profile. Taking a look at some strangles out there, right? Taking a look at, this is a going out the shorter term ones, right? Here's an October strangle, right? Selling an out of the money call, out of the money put, right? So on October 12th, the stock at 307.86, that strangle, right, was trading right at 1470, give or take. Here it is right here, right? The puts and calls both trading under a 50 IV. The puts trading just under $7. The calls trading about 780. Fast forward to Friday, right, where we saw that huge lift in implied volatility post earnings. We can see that with the stock up, right, the puts have gone now up in price, right? They are now trading more around $7. The calls certainly have gone up in price as well. These out of the money October 340 calls are now over $9. Before they were under $8, right? The puts have gone up in price as well. So that sell strangle now is 16.5 bucks. It was under 15, and the stock really hasn't changed too dramatically. It's up less than a buck, and it's more towards the ideal spot, which would be 310, right? Which is equidistant between the 280 and the 340. So the fact that implied volatility is now well over 50 and was under 50 before certainly sets up ideally for this kind of 30-ish date expiration sell strangle on the shorter term basis, a long-term straddle. And this is kind of maybe my favorite trade of all of them, simply because it won't move quite as quickly, but when it reverts, it will revert probably more quickly. So here it was September 12th, again, the stock at 307.86. The 330 straddle, right, which is out of the money on the call side, in the money on the put side, right, leaning definitely a little bullishy, right, selling a negative 54 delta, selling a 47 delta, puts you 7 deltas net long, so slightly bullish because you're selling an in the money put by 20 some points, selling out of the money call, right? You could have sold it for basically just under 70 bucks. The IV at that time about 46, right? The theta, and this is important here too, is 25 cents a day, right? So in essence, if the stock goes nowhere, or every day, if you will, you'd expect that theta to head your way by 25 cents. So time decay heads your way, right? Gamma is the negative effect anytime you sell options. It's that trade-off between theta and gamma. Fast forward to Friday, the stock is up 80 cents at 308.66. That 330 straddle, though, jumped $3.55, right? It got closer to the ideal strike price of 330, right? You'd expect with a 330 straddle, if it gets closer to 330, that the straddle price would go down. Nope, it went up. Why? Because IV jumped over 4 vol points, now over 50, was basically 46 earlier. Still 5 deltas net long selling this because the stock didn't move that much, and still have big time decay more now. Why? Because implied volatility increases theta. Implied volatility, as we know, fancy way to say the price of the option. If the option prices go up, theta, the time decay, has to go up, right? Because at expiration, right, the options will be at parity or zero or both in this case. So theta heading your way as well. Did a quick kind of walkthrough. So the smooth delta between the two dates, a 5, 7, and a 5, 6 deltas long, right? The stock went up 80 cents. So you expect selling that straddle, expect to make about a nickel on the price move from a delta perspective, right? Theta, 25 and 29, so smooth theta, about 27 cents a day, 5 days, right? So you expect to make about $1.35 in time decay, right? Because the stock really didn't go much of anywhere, right? It went up 80 cents on a $300+ stock, right? So your expected combined delta and theta gain, you'd expect to be about $1.40, but it actually went against you further by $3.55, right? That straddle increased, as we said, $3.55 because that huge jump in implied volatility. So your IV edge is actually almost 5 vol points on that. Very nice indeed, right? On a trade that is virtually neutral, right? You're leaning slightly bullishly long this, but you're capturing that huge jump in implied volatility out in January. I also did a quick little reversion. I always like to do this. We never wait for it to head back to where it was before, right? Where that IV, as we show here on kind of the longer term, we're not looking for it to go back to this level here. We're just looking for it to come back in slightly, right? So I simply went from that kind of IV where it was just over 50. What if IV just dropped back to 48, right? Not the 46 level that it was the week prior. So about halfway back to where it was the week before, what would that straddle be worth, right? So I simply plugged it in here, and you can see the straddle price would be worth $70 plus a little bit more, right? We're able to sell it for over 73 bucks, right? So you have that very nice vol edge on that one with just the IV reverting about halfway back. And for those who like the Iron Condor, this is a very nice trade as well, going out to January, giving plenty of cushion, certainly to the upside, right? So selling the 400, 410 call spread, the 280, 270 put spread, right? The week prior on September 12th, right, closed at $4.32, right, with IV much lower. After that huge jump in implied volatility, right, going over 50, right, back then it was trading around 46, the same sort of scenario. We can see that Iron Condor now over $5. So this is another way to basically take advantage of this huge jump in implied volatility in a defined risk manner, right, going out in time. And you don't have to wait anywhere near January, right? Once IV reverts, as we took a look at, right, on that straddle, once you get this reversion, you will see those prices both come back down and you can take the trade off for a gain. So hopefully provide some insight how we go about identifying them. And then if we take a look at Pilot AI, we can simply go and ask about Oracle earnings, right? What do the earnings say? And I like doing this because you can basically type in a simplistic sort of query, right? And it will spit out the last earnings report, right? Missed estimates, right? Next earnings report, analyst targets, right? Here you can see the mean price target, $200. Right now it's at 309, right? 11 strong buys. I'm sure we'll be coming out with more analyst upgrades, but you can see that huge kind of guidance increase set up for that huge pop and then drop in Oracle. Be difficult to imagine it ripping past this level here over the next month, right? And at some point you would think IV, which is not at the level it was pre-earnings, will come back down, which is all you really need for these trades to turn profitable. So until next time, as always, here's the good trading. And always remember, right, trading is all about probability, not certainty. Take care.